Hello, and thank you for joining us. There's a lot happening in the world these days, and many of you be wondering how to work your way through it. Today's presentation, Navigating Your Investment Strategy in Today's Economy, will hopefully give you some insight and ideas on how to proceed. But first, we respectfully acknowledge that this event is being broadcast from the traditional and unceded territories of the Lil'wat, Musqueam, Squamish, Tsleil-Waututh Nations. I'm Kimberly Lamoureux, financial advisor and certified financial planner, and joining me today is Claudio Chisani, portfolio manager and investment advisor. A little housekeeping as we go through today's presentation. It will be recorded and available for you to replay back at a later date. You are in listen-only mode, and you can also customize your experience by changing the screen sizes on your laptop or computer or whatever device you are watching today. You will have the opportunity to engage with us throughout the presentation with some polls and question and answers at the end of our presentation. What we'll cover today is the economic landscape, what's happening in the markets, financial planning and investment fundamentals, tax considerations, portfolio optimization. We'll start things off with a little poll. How are you feeling about your financial and investment outlook this moment? You're very confident, somewhat confident, neutral, somewhat uncertain, or very uncertain. We'll give you a few minutes to put your answers in. Okay, so looking at the poll results here, most of you are feeling it's almost a tie between somewhat confident and somewhat uncertain, about 40 to 37%, and a sprinkling kind of through neutral and very confident. Excellent. Well, I hope you find some great insights in today's conversation. All right, so Claudio, looking at our landscape that we have currently going on, what are some of the key challenges and opportunities that you're finding?
Well, it's really interesting. Thank you so much, Kimberly, for co-hosting with me today. This is wonderful to be in front of our clients and individuals who are interested in the world. And if I can reverse engineer what's happening right now, I mean, if we are to be in an ideal situation, we would have interest rates that are not too high, too low. Low interest rates are always creating a situation where speculation is encouraged. High interest rates are detrimental to the economy. You'd have inflation that's under control, so consumers feeling a little bit more confident. And you'd also have no geopolitical. You would have some level of economic growth. But guess what? We have very little of that. So we have to navigate the environment and rely on the economy, reduce some of the noise from the news that we are bombarded with every day, and make sure that we have a plan for the future. So let's just dive into it, maybe go straight into things that are of importance to us. And obviously, if I can put something on the board right here, let's look at tariffs. I mean, we have spoken ad nauseum about tariffs, and are they concerning to us in the Canadian economy? There's no way to sugarcoat this. Tariffs are in reality another form of taxation, just the way inflation is. So, you know, Kimberly, look at the current environment. Tariffs, we don't know exactly where they end up being, but it is a strain on the economy, and it's a strain on a whole bunch of individuals, pretty much everybody, you know, let's face it. So if you look at the tariffs from a historical standpoint, what you will find is that if indeed there's a blanket tariff of 25% across all industries and predominantly across all countries, you are going to be in an environment that we have not seen since 1930. And 1930, to remind our clients, that was the time of depression. We're not insinuating that depression was caused by tariffs, but the tariffs have pretty much added about 3 to 4 years to a very deep and challenging economic environment. And a little bit less accentuated was 1970 when Nixon imposed a 10% tariff on imports in the United States. And back then, I was 1 year old back then. Back then tariffs affected the Canadian economy. So to think that 25% would be enduring and will have no impact on the Canadian economy and international markets would be quite naive. Now, there's one thing to keep in mind though. Tariffs are not just a measure by how much they be applied, because we've seen even today some tariffs are going to be excluded, some are going to be included. It's unclear if it's a blanket tariff or not, or just energy is 10% only, and so on and so forth. But the reality is, if they stay to the end of the year, that will have a detrimental effect on the Canadian economy. It affects GDP, it affects employment, and that could be quite problematic. Now, here's a bit of a flip side, because we always talk about the opportunities and we talk about what the future could bring. If you put things into historical perspectives, the next slide here is showing to us that whenever we had those tariffs of the 70s, of course, there was a lot of taxation on goods that came into the US, but immediately the economic activity has dropped off a cliff. In other words, the imports have been reduced dramatically because there was no activity. So the world had to find a way to negotiate these tariffs and potentially find different trading partners outside of the United States. And it's a little bit interesting because we seem to be faced the same challenge in Canada today. But what you see here, looking at this chart, is that eventually, sooner or later, those tariffs are going to be regulated by the markets themselves. And when it comes to Washington and what we hear from the current administration in the US, I truly believe that the equity markets as well as the bond markets will keep the administration honest as to how far they can go and for how long with these tariffs. So I think that's a really good idea.
Absolutely.
Yeah, I mean, going to the next chart here, what do you see here in terms of concerns from the Canadian individuals? What do you think?
Exactly. Well, when we're looking at from the Canadian investor standpoint and looking more to home soil, how do these impact how they're going to invest, and what does it impact really in Canada? So Claudio, if we're looking at this chart, it's saying that a majority of the Toronto Stock Exchange earnings aren't overly trade sensitive here. So while it will have an impact, there is lots of opportunity within the Canadian investment market for investors to go to.
Yeah, I mean, what do you have now? It's a little bit of a disconnecting between the TSX and the 300 companies that make the Toronto Stock Exchange Index and the broad economy. Very much like in 2020, not all companies have been affected by close downs and what reverberated out of that year. So financials, for instance, they're not trade sensitive and they make up more than 40% of the Canadian index. So if you look at something like that, energy comes in second at 20%, and we know energy is put aside on a shelf at 10%, at least for now. We don't know what the news might be tomorrow, but let's look at that. Then you move into the area of industrials and consumer staples and utilities. And as we dwindle down all the way to real estate and healthcare, you will notice that the company making up the TSX are not affected to the same degree as small businesses in Canada. So it's always been a bit of a differential in between where do you think the economy is in Canada and where do you think the Toronto Stock Exchange Index would be pointing. So, and I think the next couple of months will, tell us.
Totally, I completely agree. And then, that leads us right into what about the Canadian dollar and how is this going to affect that, right? So when we're looking with these new economic landscapes, what are your thoughts on how the Canadian dollar is handling this?
Canadian dollar has gotten the memo first before TSX. Because the Canadian dollar represents trading activity. So if you buy goods and services in Canada and convert to Canadian dollars, you need to convert, right? You need to basically go through an exercise of obtaining Canadian dollars, and it's a supply-demand situation where Canadian dollar goes up. Yeah, remember in the 80s and 90s, we were called the petrodollar. As oil prices were higher, the Canadian dollar was higher.
Yes.
Well, right now we don't have that as much. You've seen on the TSX and a whole bunch of other things. So right now the Canadian dollar is trying to find a floor in between 68 and 70 cents. We have gone down significantly. And the TSX, although has gone down a bit from the chart that you viewers see right now, it's still high. So I think the Canadian dollar is a true barometer of what's happening with tariffs and the economy. And it will take time for the TSX to adjust to the earnings of the companies making up the TSX. So for instance, the financial is not affected directly by tariffs. However, if you have higher unemployment, if we have changes in interest rates, eventually those companies are going to be affected. So there's a delay in between the TSX and the Canadian dollar.
Absolutely. And then, well, what about when we're looking at what are some of the differentials, you know, between like the Canadian versus US on our interest rate?
Yeah, it is the story of the perceived strength of the economy. And without doubt, the American economy has been the star of all economies for quite a while. We're looking at the last couple of years. So because of that, interest rates stayed elevated in the US. There was no need for the Fed to aggressively cut rates. However, in Canada, we anticipated that we're dealing with a sluggish economy overall. And to boost confidence, entice spending of capital, we decreased rates a lot more dramatically. So looking at this, they're almost at 200 basis points. And for the future, you also have to think, if I have a Canadian bond paying me a lot less, and I have an American counterpart bond or treasury paying me a lot more, I'm going to gravitate to the American. And because of that, the differential continues. And I think you may see the Canadian dollar even slide from 68, 69 cents lower, specifically if the tariffs persist. And that's the big if right now.
That's the big if, of course. And, you know, if they do persist, that could potentially push the US into recessionary territory as well, right?
Yes, yeah.
All right, well, there is lots going on out there. So now, with all of that being said, what are your thoughts on guaranteed investment certificates, GICs, term deposits, and how this all plays into our investors and clients' portfolios?
Yeah, you know, when it comes to term deposits, I mean, every financial instrument has a place in an investment portfolio for clients. But the term deposits have fluctuated a lot with the interest rates. This is a graph depicting investors who had a lot of liquidity in 2022, 2023 were fortunate to secure those 5%, and in some instances even 6% yields for a short period of time, 1 or 2 years. And then if they were looking at 5 years, they could still get close to 5%. Now we're staring 3.75%. And 3.75% for 5 years, you have to lock your capital for 5 years to have that rate of return. In the same breath, a 30-year bond, this is a Government of Canada bond, will be around 3.1, 3.2%. So everything seems to be normalized around 3.7, 3.5%, 3.2% in the long range, while governments will continue to lower rates on the short end, the long end may be a lot more resilient. It's very much the story of inflation. Inflation, we kept talking about bringing it down to 2%. That was the target for the Fed, and the Canadian economy having the same target. And you know what? It's sticky. It's sticky. It's not coming down as fast. And I think for our viewers, it's good to understand that there's a difference in between the short and the long side of the bond market. And GICs fall somewhere in between there, in between 5 and 10-year term rates. And because of that, you have to be careful as to when and how you lock your funds in. And there are many avenues to enhance that rate of return. But now putting money in a 5-year GIC, you're not compensated as before.
Very true. Very true. And then to our friends south of the border, there's been a lot going on, especially this week, of course, with all of the announcements that are changing every hour, it seems. What's your take on the U.S. economy? Yeah,
I mean, I know we call them friends south of the border, and you know that's a gentle term in today's environment. I mean, I'm having my coffee here, and this is an espresso. It's not an Americano. It's not a Canadiano. You know, let's just look at the U.S. economy as an overall. The U.S. economy has had pockets of strength, and if you look at the technology sector, it has been an incredible amount of growth. I mean, look.
It's been a fairy tale story that's come true, right?
It has been. Yeah. It has been. And you know, the artificial intelligence theme is still alive and well, although we see some trepidation in that area. And current discussion is a little bit too short to get into details. But I just wanted to give you a sense of what it's like to be capitalized and be part of the Magnificent Seven. They may not be as magnificent the last couple of weeks. They lost some luster, but the Magnificent Seven added $6 trillion in market cap in 2024. $6 trillion, that's a lot. I mean, think of the US deficit being at $2 trillion per year. NVIDIA alone, by generating $2 trillion, you know, in this environment, pretty much would have covered the US deficit. And I'm not giving any ideas to the US government. I'm just trying to make a point that tech has been leading the show. But there is a stark contrast, and I think the next slide is going to give you a little bit of insight. The earnings of the Magnificent Seven have been tremendous. I mean, this is the AI investment. Everybody's joking up for AI investment for a couple of reasons. Number one, there's the fear of missing out. You don't want your competitor to be having more AI tools than you do. But the second part of it is we're dealing with an aging population. And when you have aging population, there will be a need for replacement. So at some point, AI will be doing the type of jobs that we're not prepared doing. So, and I think we understand that conceptually for the long term. So the Magnificent Seven are slowing, and they're now coming into a normalized area of growth. They've been growing at 50%, 40, 50%. Some of them, you know, NVIDIA is, it's off the charts, and quite frankly, unsustainable long term. While the rest of the 493 stocks on the S&P 500, you can see it on that chart in burgundy, have barely kept pace. I mean, I kept saying capitalism has to grow at 10% to make a business case, and you see it over there. So there's been a lot of struggling even within the US economy.
Absolutely. And then, so taking a look back more broad, how about global markets? Are we seeing some opportunity on the global marketplace then?
Well, since the beginning of the year, you definitely see opportunity in returns. I mean, we're money managers, and all of our colleagues here who would be in the same category with us today. The international markets have performed the best. As a matter of fact, the Hang Seng, the Chinese market, it's up more 15, 16%. International markets are close to double digits, while the TSX and the American market are negative. And small cap, which for me is a measure of the US economy, is down about 7%. So you have a story of divergence. International markets are undervalued, and the American markets coming down a little bit. But looking at the global markets, which by the way includes the US is about 50% of that chart in terms of capitalization. What I wanted to reflect here is that if you have stability and certainty, and I know it's a big ask these days, but if you have the interest rates that are in control, not going up too much, not going down dramatically because of deflation, you have markets going up. So as long as we're able to normalize interest rates and tariffs don't affect those interest rates, and governments can run on a platform of stability, capital markets will behave really well. Markets ultimately like certainty. I mean, that's the reality.
Yep. Yeah. Very true. Yeah. Indeed.
Yeah. So now, if I can ask you, how do you approach financial planning in this environment? I know there's some elements of unknown, and clients come to us for answers. How do you do it?
How do we look at this? So with so much uncertainty out there and so many variables, it's really nice to look towards the controllables. So sitting down with clients, I like to go over all of those key financial planning aspects. You know, we're looking at your insurance planning, your investment planning, retirement planning. We're looking at tax planning, your estate planning, financial management. So these are all within the controllables, and being able to guide my clients through, or anybody that I'm working with, on what's important to them. Where do their values lie? And from there, we're able to build out something that they're feeling confident with. And then that ties into for a rate of return to match where your goals are set, and putting all of those pieces together and working for you. values. So that's where financial planning is such a huge thing. And it's very fluid, right? It's not static. So when I'm building out plans with clients, I let them know that like this is very fluid and we're all human and our minds change a lot. So when changes do happen, that's a great time to come back and meet with your advisors and your investment advisors. And then you can change course and change your navigation to align with those values and your overall end goal. So that's part of what the financial planning is. Just it's really the core to moving forward and feeling confident in where you're going and relying on the professionals that you work with and their expertise to help guide you.
Absolutely. I mean, I remember when we were putting in 2% interest of inflation rates, and we found they will never go any higher than that. And now we have to adjust some of those parameters, and we have to sit down in client meetings and see what the impact of inflation will be on a whole bunch of this, as well as risk profile.
Yeah. And just having that framework put in place, it helps give so much more, like I was saying, control and ability to guide you through those next steps and weather these wild economic events that happen and will continue to happen. They're just going to look different going on into the future.
Very true, very true. And there's many ways to approach it. I mean, if you're an investor at the beginning of your career, from a planning and investment perspective, you're going to have those quality discussions. If you come in and talk to us on the investment side, you may use dollar cost averaging. You may just decide to put money in a specific time and let your portfolio grow. And that's one strategy. You know, that's pretty simple. You know, let the emotion out of the picture and just allocate the same dollar amount. Eventually, you're going to average out okay. And then when you deal with clients who amass a certain amount of wealth, that's their retirement nest egg and beyond. Then all of a sudden, we have to do more of a tactical asset allocation where they will sit down with us and we'll discuss if we should be allocating more to stocks versus bonds. This is the time to take more risk, and we'll apply the core principles of portfolio management. So to your point, they tie in together quite nicely.
Yeah, especially with those decumulation phases and looking at how to navigate those steps.
Right.
Absolutely.
And you know, it's interesting. The more uncertain the world is, if we can put aside maybe 2 or 3 years of income just to see if we can navigate this environment in case things become volatile, that would help a lot. It would take away the burden of the rate of return, and it provides that liquidity.
Yeah. And you know, speaking to all of those pieces, that's part of the steadfast part of planning and investment planning and building out those portfolios is so that it can weather these storms. You know, and you can get through these tougher times, and it's just small tweaks here and there to get through it. And move forward and ahead with confidence.
Very true. Very true.
And then when you're looking at building out some of these investment portfolios and trying to make sure that clients are going to feel and have that security, you know, you want to look at some tax efficiency and where you would find opportunities when you're building those out to ensure that that's something that continues on into the lifetime of the plan. Can you just give us some examples of when you're looking at building out like a non-registered portfolio, what you're thinking as far as tax efficiency and how to develop that?
Yeah, I mean, good point. It's a nice segue here. The BC budget came out today, and there's good news on the front of no taxes have been increased on the personal and corporate side. So that's great, at least the proposed budget. The non-registered portfolio, if we have the registered and non-registered portfolio, I will separate the investment assets for maximum tax efficiency. So generally, you would have Canadian dividend-paying investments in your portfolio, in a non-registered portfolio, and then you have a discussion at the end of the year or mid-year and decide if you're going to take some of the capital gains, if you're going to extend some of the capital gains and pay them later. If you decide to go the distance and pay them later, perhaps you can employ a life insurance policy to pay for those taxes. And then you're just taking advantage of the compounding. You can make your fees tax deductible. You can have preferred shares as a fixed income instrument that can go into the portfolio. So there are so many things we can do in the non-registered portfolio to make sure that you're not just a GIC or a term deposit or a bond option. And ultimately, when you have a registered and non-registered portfolios, we liaise with the tax professionals and yourself for financial planning, and we decide what to do. Are we going to melt the RRSP over time? Are we going to enhance the RRSP based on where the client's tax bracket will be in the future? And then if we're enhancing the non-registered portfolio, then you're going to be tax efficient. If we're growing the RRSP, then it doesn't matter, and then you can put equities in the RRSPs and take a different stance. So there's so much to talk about. I love the situation where tax professionals, planning, and investment money managers are together in a room to discuss this.
Absolutely, and the key, one of the big takeaways here is that no two plans or investment portfolios are going to be the same. Everybody is so individual and at a different life stage or a different time in their lives or milestone. So it is really important to sit down with your professionals and they can guide you through those, because what worked for, your uncle or your neighbor or that, they might be great for them, but maybe not so great for you. Yes. And that's important to remember. Yeah. And
for our business operators, individuals who have holding companies, I mean, they get taxed, pretty aggressively as well. So if you have operating or holding companies, there's a strategy for that as well, which ties in very closely to the regular non-registered assets. And those are individual discussions that go beyond today's topic.
Absolutely. Yes. Yeah. All right. We have covered a lot today. There was definitely quite a bit of information in this webinar. And I'm sure we're going to have quite a few questions rolling in to take a look at as well. And I'm so sorry, my screen kind of froze here, so I don't see where we're going at.
Well, I mean, if you look at the, what are the trends and opportunities in your, investment portfolio, and there's so much we can basically discuss today. So I'll try to make this as simple as possible. But what are the things here that we would be, considering for the future, right? How do we optimize portfolios, and what do we think would be areas of interest? One thing that's really interesting is, we're talking about the dollar the other day. So I'm going to just open a little bit differently here, if I may. The Canadian dollar versus the American dollar. But what about the American dollar versus gold? What if gold is an inflation hedge or protection? What are we saying here? Well, what we're basically saying is that ultimately the American dollar may have a leg up on the Canadian dollar, the Australian dollar, British pound, euro, and so on and so forth. But it still seems to be losing purchasing power to gold. And that has, we've seen gold here come close to 3,000, touch that level, and being one of the best performers. So, if I had to look at...
It's also very volatile.
It is very volatile, no doubt. But, long term has a pretty nice trajectory. And I can't help but thinking, all right, I'm going to go into equities. What equities did I select in my portfolio? So the first thing is, well, we'll take a bit of a neutral stance. It's not the time to step on the gas and take a wild chance, but it's not the time to completely run to cash and expect the world to come to an end. We always have to take a balanced approach. And I always say this, if you decide to do nothing, perhaps it's okay, but you can get complacent. If you decide to do too much, you have sometimes trading costs, you have capital gains to deal with, and you may end up in the same situation. So you have to take a bit of a neutral stance when it comes to equities. Now, we seem to still like cash, and that's just our personal outlook. Some of my colleagues may have different views. Having some cash aside, not for a long time. We're not talking preserving cash for 5 years because you're going to lose the inflation. We're talking about being opportunistic with raising some cash.
Absolutely, yeah. It gives you that position so that when opportunities do present themselves, you're ready to act.
You're ready to act, exactly. And we talked about international equities. Some of the international equities trade in American dollars, so you can buy them on American exchanges. And then, what's wrong with owning some of the strongest businesses in the world that would be in that area? So international equities are great. The Airbus, the Deutsche Telekom, and just names that I'm showing here. Please don't go discriminately and buy them. They have to fit your plan. But I think those international equities did really well. They're up 14% year to date. And in terms of, if you're looking at investing in value versus growth, now obviously we seem to be shifting a little bit more towards value. Money, we've seen money in the market flow out of growth a little bit more into value as a preservation. You know, consumer staples. We all need consumer staples. So that's the, you know, healthcare. Although healthcare has been affected by a little bit of politics here, but it's still an okay sector. And then, you know, utilities. So you can design a portfolio to be extremely defensive. We've seen the American utilities and telecoms do well, but you've seen the Canadian telecoms not do very well. So that's maybe an aspect of growth and so on.
Totally. And especially coming off the heels of like such rapid growth that we saw over the last couple of years, having those opportunities to pull back, take some of those gains.
That's right.
And looking towards those value and opportunity.
And coming big picture for our clients, you know, it's always good to look at the market and understand the trends. I mean, the trend since 2020 is still up. We have not broken the large trend. We have a downtrend that has started around December 16. Those are the highs in the markets. If you go back to the American indices, Canadian indices as well, I think December 16 was the peak. And we descended from there. There's no doubt we descended from there, but the overall trend has not been broken. And one thing that I wanted to point out, because we're looking at the market, who are the participants? We know, and then those are not exact numbers, but there's $7 trillion of money market funds waiting to be deployed on the sideline. So they're waiting for good news, right? Now, we haven't gotten a lot of that lately, but eventually we might. So that's one. Yeah. There's $3 trillion of trading. Those are computer trading, automated, based on technical analysis. So when markets come down, they accelerate the trend. And that trend could be on the downside and it could be on the upside as well. And then on top of it, you have the smaller investors and risk-taking smaller investors. I mean, you can look at the Robinhood stock and where they are. It will give you a good idea of where they stand. You can look at Bitcoin and how Bitcoin trends, or the NVIDIAs and the Palantir and the Teslas of the world. Those are the type of stocks that give me a sense of what the small investor wants to do. There's a lot more speculation in that area. So there's money available, and there's a defensive play there, and the sector rotating that just happened. But we're not saying that this is broken for 2025. We're just saying that we have to be opportunistic and see if indeed the economy will deteriorate. And look at gold stocks. I mean, you know, there's a mixed story. You have Agnico Eagle as an example, doing tremendously well, but you have
Canadian-based as well,
Canadian-based, right? Exactly. But there's Barrick that can catch up. Newmont Mining, for a global player. They can catch up as well. And a lot of the producers, they've been held back by the high cost of taking the mineral, metal out of the ground. That's about 1,300 to 1,600 per ounce, depending who you're asking. But now that we're touching 3,000, you can expect those companies to do very well, right?
And they're also facing less on the tariff side of things as well, too, right? They're in that like 10%. That's right. Category where it's a lower tariff. And I mean, that might have changed already, you know, as we've been chatting here today.
But as I would finish our discussion, the world may be different, who knows? But what we're saying also, looking at the energy sector for the opportunities, I'm not fond of the price of oil going down and making a bit of a bottom, because that's a barometer for the economic activity. And at the same time, some of the oil producers have gone up in value. We know we have 10% tariffs in Canada. So we're constructive on them, but we invite a little bit of caution. So that's pretty much the equity market, right? International markets did well, big opportunity there. You know, we have the gold miners for a bit of a sector.
And then like looking at fixed income market. Because obviously we've seen those interest rates coming down. What are you seeing so far as kind of the trends for 2025 in the fixed income market?
Yeah, the fixed income market is always complex. You know, if you look at the equity market, that seems to be pretty straightforward based on where the economy is going. The fixed market would react depending on the duration. We've always liked preferred shares, especially reset preferred shares. We did really well with them last year. I think they did about 25, 26%, and that's dividend income.
That's
So if
strong.
that's phenomenal. And we're not saying that's the case. I mean, if they do 6 to 8%, perhaps 10% this year, we'll be very happy. But they're still on our radar for a couple of reasons. Number one, they will have interest rates that will stay reasonably elevated. And then secondly, they're tax efficient. So preferred shares, no problem. Now we are moving to the other side of high yield. Now high yield, some people used to call them junk bond, which, it's not a nice term, but it is, those are bonds of companies that have to issue this type of debt to the market, and they're commanding a higher premium because the quality of those companies is sometimes in question. I mean, will they make it or not? And in the high yield space, there's different levels of high yield as well. If there's a turn in the economy, high yield is going to get hit really hard. I mean, if there was a swan event, it could come from the high yield space. It could come from the U.S. dollar losing its luster down the road, or something along those lines. So we have to be careful, obviously, in the credit space. Now, we tend to be a little bit more government, and who has been chasing buying bonds for 30 to 25, 30 years in the future, or U.S. Treasuries that go 30 years. The last 2 or 3 years have been nothing but disappointment. They've had consistent negative returns. Not as bad as 2022 when they fell off the cliff, but they have been stuck in a trading range. So it's tough to get traction on these long bonds. If you think you're chasing long bonds right now, you may be disappointed. The time will come, but I don't know necessarily if it is today, right? And now there's always been the toggle in between growth and value. We run to value when the world is uncertain, and then we go to growth when we think all parameters are in place. So the artificial intelligence theme, if you have a tough economy, less advertising, the Magnificent Seven can cut budgets. Maybe they can do a whole bunch of things. There's potential tariffs coming out of Taiwan Semiconductors for NVIDIA, as they have to use those chips coming to the United States. So it is complex. And I think we have to wait for the next couple of months to see where the administration wants to go.
Yeah, shake out on that one.
And how it's going to play out. So we're still a little bit more cautious on growth, although we have to have it in the portfolio. And it's good to talk about real assets. And of course, gold is a real asset, but it's not a income producing real asset.
Exactly. Yeah.
So what I mean by that is, obviously, you help gold to preserve your purchasing power, which is good. You still have your liquidity. You still need your cash for opportunities. So let's make no mistake. You can't go 100% in gold. Although the central banks have been buying a lot of gold lately, which is a leading indicator. But then you can also look at real estate, and we have options within the investment industry to buy private or public real estate investment trusts, rental income. We know we have a shortage of housing in Canada.
It's been like a huge driver of alternative income streams, right?
Absolutely. The government has not been able to fund this in Canada. So I think the private market came in and said, if you like to get a wooden structure, 5-story, in an area where the demand is there for rental, we're going to build it. And those funds have generated 10 to 12%, and they're not correlated with the equity market at all.
Exactly. Yeah.
As a matter of fact, it's one of our top recommendations for the year for our clients. And again, I speak for myself. Our colleagues have their own investment plans in view, but I think it's important to look at the world.
Well, it's specific to individuals as well.
Absolutely. Now. What one should do in this environment overall, if we had to sort of wrap it up and get a bit of an idea of if there's a to-do list for us following today's discussion?
Exactly. I think first and foremost is there's a lot of noise out there in the marketplace, and of course they like to sensationalize and fearmonger. And if you're feeling any uncertainty whatsoever, reach out to your advisor, your financial planner, your trusted investment manager. And if you don't have one, seek one out. Referrals are great from friends and family, and that would be a good starting point. Have that meeting and ask those questions, what it is that has you worried and what are the steps you can do to mitigate that. Going back to those controllables, finding out what's important and what's of value to you. I oftentimes with clients, when they're faced with a big decision or trying to navigate their next step forward, I tell them to grab a piece of paper and a pen and write a pros and cons list for what it is that they're trying to find a decision on. And a lot of times that visceral process of writing things out will bring to light what it is that really matters to them, and that helps them in that decision process. And then working with people like myself and Claudio to help them figure out how to save their money, put their money to work, and have that plan in place to move them forward provides a lot of comfort and peace of mind. So yeah, seeking out those professionals and experts in the field and working with them can be really great at providing comfort.
Yeah, very true. I mean, it is clear the value of an investment advisor, a financial planner, financial and investment advisor. I would say the value of your team, your advisory team, and we're very much focused on this in our organization. You would not be making those mistakes because you'll have someone on your side. They'll take the emotion out of the process. They'll invite you to be proactive when it's time to be proactive. They'll invite you to stay calm when it's time to be calm, because you've seen this so many times. I mean, we've been through many things from 2000 to 2009. We shall survive. We shall survive tariffs, and we'll become a dot on that chart one day. But I hope that we'll find a way to move forward the Canadian economy, and for our clients. Ultimately, money is energy, has to be used to fulfill their goals. And to your point, when we work together, the chance of making mistakes is much less, and they can further their nest egg for themselves and their families.
Totally. I often joke saying that the number part, that's the easy stuff. It's the managing expectations and the emotions. That's where it really helps to have the expertise to guide you through.
Yeah, exactly.
Okay. Well, again, we've covered a lot in today's discussion and touching on many, many topics here. We're going to turn it over to, well, first of all, thank you so much for joining us. And I hope you found some of the things that we spoke about and touched on to be informative and give you a little bit more insight. And absolutely reach out to us, your advisors, with your questions, and make those meetings.
Yeah. And it's we're going to look at the questions that come through, and hopefully we'll do our very best to address them. Perhaps we can.
Yeah, we'll move right into some of the questions that people have been putting in throughout our discussion today. So starting off, this person is looking, they say, I want to step away from supporting US-based businesses. Should I remove US-based investments from my portfolio?
Yeah, this is a tough one. So from a quantitative standpoint, if you look at adding US equities to your investment portfolio, US equities perform the best historically. So you would be removing something that performed well. From a qualitative standpoint, and what's happening in this environment, there is a possibility to run international and Canadian equities and stay away from the American equities. If you're results focused, then US has to be in your portfolio. But if you have a philosophical challenge with what's happening today and how Canada shows against the rest of the world, and specifically against the US, until we get clear guidance as to cooperation or being at cross purposes, we can certainly do that as well. So I think you have options there based on what your moral compass is and your expectation for return.
Totally. And it's important to remember too that not all businesses that are domiciled in the States align with what is the current environment there either, right? So that's important to look at as well. So I hope that helps with your question there. And we have another one coming in. They're asking, are there any particular sectors of the Canadian economy that may benefit from the tariffs?
Yeah, I mean, a 25% blanket tariff, it's a burden for every company operating out there. But I think there's the flip side of that. If the Canadian dollar goes lower, there are parts of the economy that would become even more competitive. So tariffs at 25%, it's very tough to think can absorb them. Tariffs at 10%, perhaps better. I think a lot of this is a pre-show for the real showdown, which is the Canada-US-Mexico treaty. So, assuming all that goes well, what we talked about the precious metals and mining sector. We looked at areas that are, even the financials, because I think this ties into the question before. Canadian banks have a U.S. subsidiary. So should we remove the financial companies in the big six out of our portfolios? Or should we say, well, you know what, they won't be affected that much. So I think as long as the economy doesn't take a turn for the worse, you have the financial sector being okay. You have the real estate sector do really well, as I pointed out. And as you have the precious metals, specifically the gold mining stocks, because I think they're the point where their exploration cost at $1,300-1,500 versus the value of gold would give them a runway for excellent earnings in the future, and they're somewhat insulated. But then eventually, if we have a massive outflow of funds and a global recession out of this, then all bets are off. So we have to understand to what degree. However, there's always an opportunity somewhere. Even if you kept your assets in US dollars, if you choose to keep your assets in US dollars, would have been a 7-8% benefit, right? So, so instead of cash, and if you have it in US dollars, that cash pays 4.5% and so on. And keep in mind, there's a ton of opportunity in the fixed income market to get you above that 3.5%. You don't have to be in the equity markets to have higher rates of return.
And also just speaking to on a economic scale, some of the benefits could be more Canadian consumers are going to flock to those Canadian-based businesses, those local businesses, and really support and potentially foster small businesses within Canada. So that, I could see that being a nice positive. And we've already seen a little bit of that where people are starting to ask, oh, where was this made? This is a Canadian-based company? Oh, okay. I'll spend my money there. And, oh, it might be maybe a little bit of a premium on the price, but they know that it's staying within Canada. So that's helpful for our overall economy, right?
Yeah, and I think also the infrastructure, Canadian infrastructure in Canada, we have to start building our efficiency. We have to start building our cooperation in between provinces and then finding partners outside of the U.S. for trade. So, there will be lots of industries that will eventually be benefactors.
I think that will start to, potentially change in lights of these tariffs and having provinces working a little bit more streamlined with one another and sharing resources that way too.
Yeah.
I'm thinking of wine at this one, the wine market both across BC and Ontario.
The wine market. Yeah, it is. True. Although in BC, I think we gave a pass to California, maybe our premier Lake Chardonnay. Because in BC we said only the red states would be affected for wine, so we may get some American wine there. It's so confusing. I don't really know what's going to transpire. But well.
So we'll jump on to another question here because we have a little bit more time, so I want to get to as many questions as possible. So looking at this one, what are some good tactics for a first-time investor to consider? And so first time, amazing, you're looking at starting to have your money do a little bit more for you. Fantastic, you're taking that first big step. And depending on where you are at in your life stage, obviously the younger you are, the longer time horizon until you may need to access those funds is, which allows you to be able to ride out market fluctuations, and it smooths it out over the long term, right? So again, it's really individual depending on where you're at, where you would want to start. And sometimes just starting with that initial little term deposit can be a huge first step, and then moving on and maybe looking at starting a mutual fund account, and then that being the next step. But again, it is very individual, and it really depends on those big factors like time horizon being the biggest one and what your risk tolerance is. Seeking advice is important.
Yeah, I think the number one thing is to consider is that if you are a first-time investor, you have to invest in a relationship with your advisor. Just make sure that you have a little bit of knowledge. You're going to gather knowledge over time. Your portfolio will grow, your objectives will grow, and you will become a lot more prone to generating the right returns. That's key to your point. And the tactics of dollar cost averaging or debt reduction, or those are part of planning and something that Kimberly does day in and day out.
Totally. We look at all of those factors for sure.
Yeah.
They're big parts of it. And okay, moving on to our next question here.
Yes.
And this one's asking, do you recommend during these times to invest long-term, 3 or 5 year, or short-term, 1 year or 18 months? So I'm wondering if this is more based on like GICs and term deposits.
Yeah, we can
trying to extract from that
question.
Yeah.
It's a little bit it's vague because if you're a long-term investor, you're going to be long-term focused. But if you're looking at the horizon, we have the uncertainty of interest rates, right? What would the tariffs create inflation? And if the answer is yes, could potentially interest rates go higher? So that's your number one concern. So then if that's the case, you'd stay short-term. Would you lock something for 3 to 5 years in a term deposit? Well, if I try to lock something 3 to 5 years, I think that's too much of a commitment. And you've seen the term deposit rate of 3.75. Chances are, if the economy worsens, that rate will go down a little bit too.
And they've already started to come down a little bit more, right?
So you could be at 3%. So if you're at 3% or around 3% is happens to be your rate of return benchmark, yes. Now, if we step outside a term deposit and we're looking at stocks, I say every time you look at stocks, mutual funds, and any type of equity type investment, you have to give it 3 to 5 years. Yeah. So I think that is a must, because you have to be able to absorb some levels of volatility, and you will be rewarded accordingly, but it takes time.
It does take time. And that just goes back to the question before of, just looking at those goals, like what is the ultimate goal for these funds, this particular funds? Is it because you're saving for next year's vacation or a vacation that's in 2 years? Okay, well, maybe you're going to look at those short-term, 1 year, 18 months and locking it in. But if it's something like your retirement, for example, well, long runway. So yes. You're going to look at investments from a different perspective on that. Yeah. Exactly. Moving along here. These are great questions, by the way. Thank you. Thank you for asking these. What other financial markets, like emerging or Japan, like Buffett has invested in, would you suggest? Why has Buffett stayed liquid?
Yeah, there's Buffett has always been a proponent, an ambassador for buying value stocks. Mm-hmm. And in today's, having such great rallies, over the last 20 years, if you look at the U.S. equity market, it's very tough to find value. And the original idea was that perhaps Buffett is jockeying for buying some significant businesses and needs liquidity. But I think his stance is he wants to wait and see where the U.S. economy is going. And we have pretty much the same stance as him. A lot of people said, well, Buffett, maybe this time he didn't get it right. I wouldn't bet a track record as Warren Buffett's. That's quite clear. So my view is that he's waiting and anticipating for a bargain, and that bargain could be presented by the market if indeed the tariff talk and the geopolitical will give an opportunity for the assets to be bought at a lower price. Mm-hmm. He's very strategic that way, and he never deviated from his plan of finding value. Yeah. And it's very tough to find true value in today's market.
Yeah, and taking those gains when he had them.
Yeah.
Right?
Yeah, absolutely.
That was also part of it. It's like,
yeah, exactly.
You know what? This has run its course. I'm good.
Yeah.
But again, that's his strategy. It's not for everybody. Yeah. Like I said before, we're all individuals. Now, this one is asking a little bit more specific here, Claudio. Will BlackRock issue a Panama Canal fund for investors to take advantage of their recent purchase?
Well, I'm not on the board of directors of BlackRock to tell you exactly which way this will go. If they do, I mean, BlackRock has been opportunistic in so many areas, as you know. They issue funds, they participate in crypto and a whole bunch of other things. So I wouldn't know. I will say that whenever you have a question mark like this, you have to wait for 6 to 12 months. And the answer is going to become obvious outside of the press. So I can't really speculate on what they'll be doing in that area, but it's something to keep in mind. You know, everything is interconnected, and there's many financial institutions out there looking for having an edge. So it may well be.
Yeah, we'll have to wait and see. What would you recommend investing in if you wanted to get a high return but want to have your principal guaranteed?
Well, I mean, principal guaranteed.
I mean, that's more like in a kind of a structured note type
that's
idea,
right?
That's
right.
Or like a market-linked term deposit, for example.
That's correct. I mean, there's ways to put a little bit of a buffer. I mean, there's an instrument out there called the principal protected note. So you know, you put $10,000 today, and you're going to have 10,000 5 years from now. The return of that note could be linked to many things. Could be linked to the Japanese market, could be linked to the European market, could be linked to NASDAQ or a basket of stocks. So if they don't perform well, you will get your principal back. If you are in an area and you got that right, that return could be quite significant, right? I mean, we can make a principal protected note, perhaps. We can link it to gold miners. You can link it to a whole bunch of things. So there are synthetic instruments in the market that will give you that sort of diversification. Just keep in mind that those principal protected notes are taxed as interest income. They're not capital gains. And you don't have the liquidity. So if you commit it to 3 or 5 years, you will have to stay in it. I mean, you can sell it in the market, but that will not be guaranteed. You would be at the vagary of the market if you decide to sell before maturity, if you need the funds, whatever the case.
Thank you for that. Okay, looking at, I think we have time for one more question here today. And these have all been really, really great. Thank you so much. And unfortunately, we won't have time to get to all the questions, but we will after the presentation today and get back to those ones that were asked. So will these tariffs have the impetus to help rebuild the American manufacturing base? Do you see any opportunities in the manufacturing sector in the US? That's a good question. Yeah.
Yeah, I mean,
tricky though.
It is, you can look at it 2 ways. We want to build manufacturing. So we're going to bring all manufacturing in the United States, ideally for the United States. But that takes a lot of capital investment. So you're making an investment for 5 to 10 years in a plant, in a manufacturing plant, whatever the case might be, thinking that that's a strategic point for you. Now, if for manufacturing, the US becomes 100% independent, then there will be no more tariffs because they won't import anything. They'll have everything they require within their country. So you have a little bit of a timing situation with the two. So what I mean by that, you know, if we could just turn a switch and use the tariff money, assuming they get the tariff money to that degree, and then put it in the economy and revive the industries, look how long it took China to build their manufacturing. I mean, they started this in 2020 to the point where China right now does about $3.3 trillion in goods and services they export around the world, and they have all their factories there. And you also know that that's a society where if the factory has to be placed in location A, it will be in location A. You don't have the same situation in the US with different states and different regulations and many other aspects. So I think it's the long game. I mean, that was the idea. However, we don't know how long tariffs would go for. So that's a bit of a gamble of the company deciding to do that. Right? I mean, and of course they're looking at various areas. I mean, we're talking about the NVIDIA chips. They're talking about Taiwan semiconductors coming to the United States. Maybe, maybe not. Maybe they'll go to Europe. So there are opportunities for the manufacturing sector, but I'll have to say that is the long and slow process. You will not see that overnight. As a matter of fact, what you will see more than anything else is automation will give you that advantage. We need robotics to help because the cost of labor is pretty high. So,
Yeah.
it's a bit of a 50-50 for me.
Absolutely. All right. Well, thank you again for joining us for today's presentation. Hope you found some insights in that, and please reach out with any other questions that you may have. Seek advice from your experts, your financial advisor, financial planner, your investment advisor, portfolio manager. We appreciate you giving us your time today.
Thank you very much. Thank you.